Hello and welcome to a spring edition of a 401k checkup presented by TrustPoint. I'm Kurt Siegel. I'll be your host. Thank you for joining us. For the next 30 minutes or so, we'll talk about a number of things and examine the effects on markets, on your 401k, and what the responses might be to the pandemic and the volatility that has been prevalent recently. So let's start by taking inventory. First and foremost, taking care of yourself and your family is of utmost importance. Everyone's been asked to make big changes and sacrifices to their lives. Financials certainly are one thing, but taking care of yourself, both emotionally with all the change and your health, are really important. There's been work disruptions for everybody. Maybe you're working at home at this point, or possibly have incurred a reduction in income due to fewer hours being worked. Some people have been furloughed, some even laid off. So you've had time now to consider the impact, the ramifications on yourself and your family, and you're making adjustments. In the next few minutes, we're going to discuss the financial impacts on you and potentially on people close to you. We'll discuss those in more detail and what steps you might take or may need to take in response. Now, this economic shock has come on very suddenly, and it feels very differently. It may feel like we're someplace we've never been before, and in a sense, that's true. Now, you can see from the list of causes of prior recessions, and this one is likely to be a domestic and global recession. The previous causes have all been economically driven, economic events. And this time, it's a health crisis that's upset things. Now, in the big sense, they're very different. And there is one similarity that is very large and looming as well. And that's that we've always gotten through these recessions in the past, and we'll get through this one as well. So let's look at what some previous downturns have actually looked like. It's common to have 5 or 10% drops in stock market values and 401k values as a result. They happen respectively on average 3 times a year or about once a year in the case of 10%. Now, 15 or 20% and even more greater drawdowns are far less frequent. A 20% loss of value or more is usually associated with a recession. And thankfully, they only happen about once every 6 or 7 years. Now, the last time we had a recession was about 11 years ago in 2008, 2009. And stock values dropped about 50% during that period of time. Now let's look at what recoveries look like and how markets have behaved following the bottoming process of stock prices. For example, on the left side of the slide, an investor who stayed in the market after 1 year on average had a 60% recovery from the bottom. After 2 years, a cumulative 90%, and after 3 years, over 100%. Now, what really stands out about this slide is that missing even the first month of that recovery cuts returns in about half. And missing more than that is even more dramatic. So here you can see on this slide what some of the more recent recessions look like in terms of time. And if you focus on the third column, you see what the peak to trough decline has been in stock prices from the top to the bottom before recovery. And you also notice that the last couple of recessions at the bottom have been a couple of the worst and deepest. The average decline in stock prices has been about 30%. And from these recessions, the average one-year return from the bottom has been 46%. And over 5 years, the average annual return is almost 20% a year, which is far greater than the average long-term returns in stocks. What's it going to look like this time? Well, we don't know yet. What we can say is that so far, the peak to trough decline actually is minus 34%. And we've had a significant bounce off the bottom. We don't know what the one-year return will be, nor do we know how long this is going to last. Now let's consider the steps that have been taken by TrustPoint. Now, first of all, with respect to your investment choices in the 401k, there's really two broad categories. First, on the bottom part of the slide, you may choose from a large number of individual mutual funds in building your own investment portfolio. Those funds cover a broad range of stock and bond market options. We call this the do-it-yourself method. And people who use this option usually know something about those mutual funds, or they have a trusted advisor that they can rely on. Now, alternatively, we have offered what are called profile funds. These are managed by TrustPoint. So the mutual funds within the profile, and there are 5 of them, the mutual funds are managed by TrustPoint to a particular age or risk tolerance. There are 5 choices. They look like this. So in the bottom left-hand corner, the profile indicated as fixed income is 100% invested in bonds. It is therefore the lowest volatility, lowest risk, and has the lowest expected return over time. As you move out to the right, each successive profile has more stock market exposure, and as a result has a higher expected return, and it's going to be more volatile in price. If you're uncertain which is the appropriate profile for you, I hope you will revisit the risk tolerance questionnaire. It's available on our website. You don't need to sign in. You would go to trustpointinc.com and click on the button or tab that's marked 401k plans, and then further click on the drop down where it says resources, and the risk tolerance questionnaire is there. It's very short. It's about 9 questions that explore both the time period in which you expect to use the money in the 401k and how you're going to react to market volatility and the ups and downs, and particularly the downs of a portfolio value. And when that's said and done and you total up that score, it will point you toward one of the profile accounts, one of those asset allocation models that has a certain number, a certain percentage of stock or bonds in it. And you could use the same questionnaire in building your portfolio from individual mutual funds as well. Now, the steps that TrustPoint has taken. Again, we're going to focus on the managed option, that is the profile fund. And entering into 2020, we came into the year slightly underweight equities or stocks to begin with, after having taken some reduction in stocks back in August of 2019 and then again late in 2019. And as stock prices dropped dramatically in February and March, that underweight became more so. It drifted down even more so. Now, during this period, we've made the investment team has made no additional changes to the profiles as yet, as a result of expecting continued volatility. The indiscriminate selling in February and March led to a big bounce back in prices, literally about 30%. Now remember, I said the stocks dropped 34% from peak to trough. And we've had a bounce off the bottom of about 30%. You might think you're almost back to even, but remember that the drop, the 34% decline, is off the peak prices, and the bounce is off a much lower number. The 30% bounce is off a much lower number. So we're still about 15% off what was the peak in stock prices. Now, while opportunities have and continue to exist, the team is not yet convinced that a new long-term uptrend has begun. They'll be looking at adding back to stocks at some point in the future. Now, in the meantime, we are continuously monitoring the funds and the profiles and the opportunities, and communicating via webinars like this, as well as others that are listed and available on our website. So do visit the website to be periodically updated on economic and investment updates. Okay, so as you know, all investments have a risk. There is this adage of you get no gain without pain. People's reactions to the kind of drops in stock prices and the volatility differ greatly. People have different investment personalities, if you will. Here's a look at a couple of hypothetical investors, just to set the stage for the differences between us when we deal with this volatility. For instance, by now I'm sure you have your first quarter statement, and when you open that, I wouldn't be surprised if many of you were just shocked by the price. Well, we're trying to illustrate here in a hypothetical example how investors might react differently to such dramatic changes in price. So this study goes back to 1978, and we had two investors: the opportunistic investor, shown in the blue graph, and a more apprehensive investor, shown in the orange graph. Both in 1978 invested $10,000 in the US stock market. And the dots represent each and every time the stock market dropped 8% or more in a particular month. So there's about 14 different times on this chart, 14 different dots combinations. And if we extended this to the current time, there'd be a few more dots. Now, the way these two hypothetical investors reacted were diametrically opposed. The opportunistic investor, every time the market dropped 8%, added $2,000 to his or her stock market investments. And the apprehensive investor withdrew $2,000 and put it in a safe investment. Withdrew that money because of the uncertainty he or she faced with respect to how bad this was going to get. And if the market was as bad as the news sounded, this was likely to get worse. And the feeling was, I need to do something defensive. But you can see over time a couple of things. One, there's a dramatic difference over time between the investment results, and also that every time we've been in very volatile climates, the stock market has recovered. It's always benefited the investor who stayed in and even became more aggressive in face of lower stock market prices. Now let's talk a little bit about steps you might consider and might take. First of all, as a 401k investor, you already are taking advantage of what we call dollar cost averaging by making a contribution every payroll period. You have a systematic investment plan underway. And as a result of volatility, you're going to have a better outcome following that volatile period. Let me show you in the slide. Focus on the blue bar graphs. And in this example, an investor is investing $1,000 every month. Now, it could be any dollar amount, any consistent amount that would work. In this case, $1,000 at the beginning of the year when prices of stocks were at a $25 level, that $1,000 bought 40 shares of stock. And as prices declined in the spring and in the summer, the $1,000 kept buying more and more shares each month, 50 shares, and then 60 and over 60 shares. And by the time the stock market recovered after its cycle, the average cost for that period the investor had was $19.44. And when the prices recovered, there was a 30% profit back to $25 a share, about a 30% profit. So you can see in the face of volatility and dropping stock prices, accumulating more shares at a lower price are going to result in better returns. And that's how the opportunistic investor in the previous slide with the blue investor, benefited so much more greatly than the apprehensive investor. Now let's spend a couple of minutes talking about the impact on your income and your assets. This topic has been divided into two categories: a moderate or severe impact, which would indicate that income has been reduced or maybe lost entirely due to being furloughed or laid off. Asset values, the asset value of the 401k, your IRA, any other investment assets have been severely eroded, and the presumption is they're going to be needed as a result of the loss of income. Now, this may reflect somewhat your situation or someone you are close to, a family member that you can relate to. The other category would be a mild to no material effect on income. That would indicate a stable income, one is still working, at least so far, there hasn't been a cutback or erosion of income. But asset values, again, 401k and any other investments have been eroded, but they're not expected to be needed as a result of the ongoing income. So let's take a look at what some of the considerations might be. And there are several action steps that could be taken. For the individual with little impact on income, it's a great time to reflect on the fact that an emergency fund is really important in times like this, particularly if the impact were greater. And it's a good time to add to it, build it up if you don't have it. It's also a good time to eliminate high interest rate debt from credit cards. Many people's spending during this period of time is actually lower, and they may have more discretionary income with which to do things, such as those first two bullet points. It's a good time to rethink, revisit your financial objectives. Have they in any way changed? Has the time period in which you expect to use your 401k assets changed? Has anything else changed that may cause a alteration of what you do with your savings? Now, as TrustPoint will be and continues to manage the profile accounts, this may be a time to rebalance any drift in your 401k mutual fund investment portfolio, if it's mutual funds as opposed to profile funds, or any other outside investments you may have. If you're of an age where you would be required to take a minimum distribution from an IRA or from a 401k, the CARES Act, signed in March, allows one to forego taking that required minimum distribution this year or even pay it back. Opportunistically, you might increase your contribution rates, the percentage as you contribute or the dollar amounts. as there is more perceived value created in stocks during periods of volatility. If you have a philanthropic plan in place, it's a great time to just review that, determine if the pandemic crisis has made it, would cause any changes to that for you and your family. And again, it's a good time to seek assistance, obtain a financial review. It may not be done immediately, but as a result of all this, it's good to take a global, holistic look at not only your 401k, but your whole financial picture when you have time to address that. And finally, for the dollars that you are able to continue to spend, certainly support your local economy where those dollars are badly needed. Now, for the person who's more moderately to severely impacted, or with a family member that might be in that situation, it's really important to focus on needs versus wants. And of course, those include food and shelter, and utilities need to get paid, transportation needs to be kept up. And of course, one's health care and healthcare costs and premiums need to be considered, all those basic needs. It's a great time to explore the CARES Relief Act again, as there are many postponement or forbearance options offered. For instance, the college loans that many people carry, the payments on those can be deferred till the end of the year. Eliminated is not the right word, but deferred to a later time, at least till the end of the year, if one chooses. The major banks, I know, have instituted delays or postponements of 3 months on payments on such things as auto loans or leases, mortgage payments, home equity loans, and even credit card payments. So you can push those out. In the case of auto loans, those payments get tacked onto the end of the loan, for example, all in that final payment. Insurance carriers or providers, they've also incorporated flexibility into premium payments. So explore all the options for one's obligations, and call the company or search the internet under the company's website to see what sort of flexibility is available. Now, with respect to the 401k, if funds are short, then you have options there as well. For instance, contributions could be reduced or eliminated. And that can be done quickly through the use of a contribution deferral form available through HR or on the website. It can be printed. And sometimes it can also even be done automatically on the website, depending on your plan. Now, that will entail potentially a loss of dollars that your employer may be matching alongside the contributions you're making. It will also eliminate that dollar cost averaging or buying low strategy, and combined, this may impact the future opportunity or recovery of your 401k. But it's available and it's flexible. As easily as it is to turn it off, the contributions, you can turn them back on. Also, 401ks and IRAs have some optionality with respect to making withdrawals. Now, under the CARES Act, any penalties, tax penalties that otherwise would have been charged in normal times have been eliminated. Income taxes due could be spread out over as long as 3 years if one needs to. Again, it's going to affect potential future opportunities and growth. You will not be, you may be liquidating your positions at a low point, and it just may make this whole process of getting back to even that much more difficult when monies are actually withdrawn. But there's optionality to do so. And again, it's important to review your options and your objectives. If your objectives haven't changed, there may be no good reason or no necessity to change your investment strategy at this point. as long as your options and your objectives haven't changed. Now let's just take a little another look. This is a look at the past recession, most recent recession in 2008, 2009. And for perspective purposes, what you see here, represented by the light blue line, is the stock market peak in 2007, at the end of 2007. The subsequent decline of about 50% in price value over 16 months, and then a long, rather choppy at times, recovery in stock prices. The blue line, light blue line, also represents what would have happened to an investor who stayed invested during that period of time. So a peak in November of 2007, a bottom in March of 2009, and then a recovery back to even in the first calendar quarter of 2012. That was about a 4.5-year cycle, one of the deepest and longest cycles of recessionary conditions and stock market decline and recovery for the full cycle. The dark blue line represents the impact of an investor who got out of the market at or near the bottom in March of 2009, stayed out of the market for 12 months, and then found the nerve to re-enter as a result of some stock price recovery, I presume, and then continued to follow the path of the stock market, but never, as a result of being out for a year, never able to catch up with the investor who stayed in. The green line represents the risk-averse investor who probably found themselves way out over their skis with having too much stock, too much risk when this occurred, made a decision to get out at the bottom and then never re-enter, put the money in T-bills and earned a low interest rate ever since. This is the classic stocks, bonds, and bills chart and returns relative to inflation going back over a long period of time. You can see, beginning on the bottom left, that each asset category, small stocks, large stocks, government bonds, and so on, begin in 1926 at $1. And then through a very choppy period in the 20s and 30s, followed by long growth periods thereafter. In the middle of the chart are the 1970s, when we faced very high inflation rates and stagnant economy, not much going on there for several years, and then a continuation of stock prices and bond values. Now, during this whole period of time, and this is, none of us have had money invested in 1926, but the idea of this is to keep this broad picture in mind when you think about what your reaction is going to be and needs to be or should be with respect to stock market volatility. Again, like the opportunistic investor that started in 1978, markets have always worked out, but it does take time. And as long as you don't have to use the money right away or all of the money right away, then these lessons indicate that staying the course has always paid off and probably will in the future. So the other thing about this chart is that each and every one of these asset categories and markets have experienced a depression or two. There's been recessions in there, wars, terrorist attacks. There's been periods of double-digit inflation. There's been deflation and oil price shocks. And all of this combined has still led to good long-term returns, very good long-term returns. Now, as we get close to the end, I just want to remind everyone that on the website, when you do sign in using your ID and password, there are a lot of different resources, and one of those is called the Financial Resource Center. It's a tab on the website. It is chock full of good articles on investing, calculators and tabulators to help you work your way through understanding your objectives and ways to meet them. And they're all arranged by age group in the Financial Resource Center. I would encourage you to wander back and forth among age groups to find some of the most meaningful material for you. It's not necessarily, a lot of these things kind of overlap and so forth. So I would encourage you to look at that if you haven't before. And then one of the most recent additions to the website is what we call MyRetirement. So when you sign in and go to the dashboard and see your balance, there is an area for the MyRetirement analysis tool. And you can see in this case, it has a dollar amount in it. And the purpose of this tool is to give you a very good, highly reliable monthly income amount that you might be able to draw from this at retirement time. It is the most sophisticated tool that we've been able to find and make available to you, and it considers not only what you're putting in currently, but your contribution from your employer, the type of investor you are, and it builds off of what you expect to be using as a retirement date, as well as a life expectancy. You know, you don't want to run out of money, so you want to consider, you know, maybe a moderate life expectancy and then rerun it for a long-term life expectancy to see what this monthly income is liable to be. And you could add in spousal information, and you can even put in Social Security estimates as well and get an idea what that total retirement monthly income is going to be, and then compare it to what you think your budget's going to look like in retirement. People's budgets change, and oftentimes they're a little bit less in retirement than they were when they were working. So I encourage you to use this as well as a tool. As we draw to an end here, I want to say, if you have any questions about anything we've talked about here, please reach out to us at TrustPoint at the number on the screen. We'll be most happy to discuss all options and be as helpful as we can. In the meantime, I would say be safe, and until we meet again, goodbye for now.